Thank you for joining us today. My name is David Steinbach, and I'm the Global Chief Investment Officer at Hines.
Good afternoon, everyone. My name is Steve Luthman. I'm the Global Head of Real Estate at Hines.
Today, we're going to have a conversation about some of the dynamics that we are seeing in the market. We both have global roles and have a unique perspective in terms of what's happening in the world around us. And it's certainly an era of change. I think we're all feeling that in our own businesses and as we read the headlines of the news today. But we're going to dialogue about how to think about where those changes are happening, what's the signal and noise, and also where the opportunities are embedded in that. So, Steve, first with you. Gosh, it feels like a lot is happening in the macro context, and it does feel like this era that was about 40-year run concluded probably sometime in 2022 when interest rates had their historic 500 basis point climb. And to me, at least, it felt like that closed a chapter, and a new chapter is opening. And part of what the industry is doing right now is trying to figure out exactly what that looks like and what the rules of the game are going to be. Do you feel that?
Yeah, there's really no question. I mean, you talked about the interest rate paradigm that we were in and that we're now in a new one. But over the course of the last 40 years, the asset sectors have become so siloed. You're an office investor, you're a multifamily investor, an industrial investor, and what we're really starting to see is kind of a blending of that, not only as investors think about it, but really by product type.
Right.
Office, for example, has completely embraced the residential ethos, and lobbies are no longer places to pass through. They're places to see and be seen. They're places to collaborate. They're places to work, and that's really bringing the residential into the office. Vice versa, residential, we've been starting to see a lot of the use of creating workspaces in our residential buildings. But it's really in every asset class, David. Industrial has always been there to serve logistics and logistical dynamics, and now it's a form of retail, and it's a form of last mile delivery of what people need to live their lives. And so that convergence of asset classes that we're really seeing is a fundamental shift in our industry, that investors are looking more holistically about how asset classes are synergistic to create incremental value. So how we think about asset selection and how we ultimately manage assets is what's going to create incremental returns for those assets. And we really do believe that thinking holistically about the synergistic uses within asset classes is the way to create incremental value.
Yeah, man. I mean, there's a lot to unpack, and everything you're just going through. I think that's great. Let's maybe move into convergence of real assets more holistically. And I know you and I've talked a lot about this, just even in the last year. And certainly, Hines has focused on we would say the built environment real estate, and for us that's meant some specific things over the years. But we've also done other things too, and just kind of put them in the bucket of real estate. In our industry, I'll say our industry, has gone through over the last 40 years a lot of I would call it institutionalization, where and it was caused because capital was looking for returns, but it was also enabled because opacity that our industry was defined by has been just incrementally, step by step, eradicated and created a lot of transparency. And I think that transparency created liquidity, liquidity created returns. And so that's been the real estate industry's journey that certainly we have felt over the years. And it feels like infrastructure as an asset class is also undergoing a transition. It's a newer product type compared to real estate. So maybe it's a teenager compared to where real estate is. But it does feel like these worlds are starting to come together, and we're seeing it with our own investors, right? In terms of how they're looking at their own teams, and they want to get away from silos. And data centers in many ways was that canary in the coal mine, that they have to look at things more holistically. I'm curious how you have seen infrastructure historically at Hines in terms of what we've done, and maybe some things that we need to call infrastructure, but we always call real estate.
Well, that convergence is obviously happening all over the world in terms of our LPs and our investors that are really trying to think about how do we create durable cash flows in a world that's higher for longer. What is going to drive those? And infrastructure is a place that there's there's real durability, long-term duration of those cash flows, which is attractive to the investors that are trying to match their obligations with their investment returns. So that is obviously happening. The way we're experiencing it is the process of the creation of infrastructure is one that it requires so much planning in advance. It requires a lot of stakeholder engagement. What we're seeing is that market is coming towards those that know how to plan, know how to entitle, know how to phase, and know how to execute. The U.S. needs about $9 trillion of infrastructure. Europe needs about $1 trillion of infrastructure. The acknowledgement of that and the investing in that, because we're in a changing environment, that creates tremendous opportunities for those that understand how to access, capitalize, and execute on industrial projects. The scarce resource is also those that can bring capital. Cities across the world are stretched with their budgets, yet they have infrastructure needs, whether they be bridges, whether they be convention centers, whether they be hotels, airports. And so those that can bring the know-how, the boots and brains on the ground to execute, but also have the relationships with the largest investors in the world that want it, bringing those together and accessing these infrastructure investment opportunities is the next chapter. We've historically thought of infrastructure as so many different things. We think about sports adjacent districts. One of the biggest waves that's occurring right now is the investment by teams into the stadium districts that surround their stadiums, and that's really exciting. That's real estate, that's infrastructure, that's public-private, that's all these things coming together, and having access to those investment opportunities, but then also being a channel for investors that want that is something that we're really excited about.
And it does feel like some of the magic that's going to happen the next 5 to 10 years in this is, as these things come together, how to bring them together in some really interesting ways and have the crossover effect be exponential in terms of what's possible. And maybe something like a convention center or even an airport that is seen, it's not about the gates and the runway, it's about the user experience, the customer experience. And the magic is the F&B that to me is a real estate solution. So anyway, it'd be interesting to see how that really plays out and everything, right? Because that's also, I think, it's going to be fun for our teams to be able to bring that out and bring that creativity to that, and then bring those opportunities to our investors. So.
Yes, indeed. I love that concept that an airport is really just a place for people. And if you know how to create great places for people, you know how to create the special sauce that exists at that airport, yet investors are thinking about the long duration of cash flows that airport can provide. So merging those two, real estate and the infrastructure together is the power.
It's gonna be fun to watch. The other thing that I think would be good to unpack is data centers. And I remember last year we put out a paper on powered land, and I got so many comments about that in terms of people surprised that we were doing that. And for us, it was so. It was of course we would be doing that. I guess maybe I'd describe how we kind of got into that and how we have approached that, and then maybe even what the other elements to that could be as we think about other extensions of that.
Sure. You think about our platform, we're in 383 cities across the world, and while we are a large investment manager, we have a DNA of development. And so the teams that are in each of those markets are really good at entitlement and really good at land procurement. That's something that I would say is one of our core competencies. What we found over the last 2 or 3 years is that when you overlay those skills of entitlement and land procurement and land control with power procurement, that creates a value that is extremely valuable to those that want to then go vertical and create data center infrastructure. We have felt, especially in our business in Europe, that the land control, the entitlement, and the power procurement is where we can add the most value. And then we've oftentimes sold the entitled and powered land off to either hyperscalers or operators that want to then go vertical. The next phase of that is obviously developing the data centers ourselves and partnering with the large end users. We're doing that in Milan right now. We did it in Frankfurt, and we're doing it in the United States. That's obviously the next large scale sort of opportunity in front of us.
And I love that framing, right? Because it feels like when we think about our own talent, our own how we want to staff and just resource different things, focusing on what the scarce resource is and making that agnostic, but the highest and best use and every day, and being creative every day, and that to me is a very special thing to be able to do that. As you said, 380 cities around the world is going to create some uncommon outcomes. I know for sure.
One thing that we've really started to do, as you know, at investment committee, is we think about our industrial acquisition business. Um, that is changing so rapidly in front of us. So there's just so much optionality that comes from an industrial acquisition. It can obviously be a logistics
Yeah.
with long leases to our logistics users, our partners, like a DHL or like
Right.
UPS. It also can be a covered land play for a future data center. So as you're enjoying the income from the industrial, to be spending the time creating the value that of bringing the power to the site. So again, covered land play, and then now industrial. What we're starting to see, we've done leases with Tesla all over the world. We're starting to see them come to us and say, we want to use this space in a different way than we have before. One interesting conversation is just the light manufacturing of some of their robotics initiatives into our industrial buildings.
Right, and that's a fascinating framing too, just in terms of just the amount of capital. It feels like we're in this capital intensive era, right? That a lot needs to be built. A lot needs to be built. But I guess just to take two threads on that, one is where is it going to be built, and what's in the way of it getting built. First, on what's in the way, it does, from an investment perspective, it does feel like that risk-adjusted return you'd expect to justify new development as an investor isn't there yet. I guess, how do you think about that? And then second, get into the where that's going to happen.
Well, I mean the biggest point that's changed in this development cycle, and I agree that we're in a capital intensive environment, whether you're thinking about the AI growth and the need for data centers, the need for power, power generation, all of that requires tremendous capital investments. On the what I'll call the traditional real estate asset classes, we're in a supply starved market in Europe, in Asia Pacific, and in the Americas, which as an investor is a really, really interesting time to be thinking about placing capital, because the laws of supply and demand are really powerful in our business. And when you're in a market with demographic tailwinds with no supply, that's an opportunity for really interesting investment returns.
I mean, you've lived through a couple development cycles, right? And I do think that people don't often realize kind of some of the dynamics that are at play. But you've been in cities when it's been hard, as it's moved into easy and then too easy. Maybe describe a little bit of how that plays out on the ground. I mean, I think that's an interesting dynamic. There's some pattern recognition there in terms of what you've seen.
To not oversimplify, but throughout the course of my 21-year career at Hines and 30-year career in real estate, the required returns for development were between 18 and 22% levered returns. And we've seen an increase in the required return for development of between 200 and 400 basis points. So it was 18 to 22 is now 22 to 26. And so for many investors, why take the risk of development? And so that's created an environment that if you're a developer, it's really frustrating. If you're an investor, it's really exciting. The required rate of return on development is really what's stalled new development in the US and abroad. And as you understand that, it gives you more confidence to invest in existing income producing assets that ultimately will draft up in the absence of new construction.
But it does feel like investors, there is a herd mentality a lot of investors have, because everyone has an investment committee. Everybody has, things they look for, and certainly, the risk premium is a significant one. It does feel like a lot of investors kind of get this wrong in terms of acting too late, getting into development, and it does feel like one of these opportunities that we should be thinking about.
I think that's wise. I've always said that one of the great things about working for Hines is that we have a sort of a deep ballast of property management and asset management business that enables us to hold on to our development talent through ups and down cycles. That enables us to act early in the cycle and to invest when others are afraid of investing into new development. The best returns over the course of my career, if you break a cycle into thirds, have happened for taking risk early cycle, because at that point you've already delivered while the rest of the market is coming towards the desire for those types of assets. Construction costs are generally lower, better architecture teams working on the projects, better construction execution relationships, because everyone's hungry early in cycle.
It is interesting too. I mean, we are talking about convergence today, and there's some different threads we're going to pick up. But it is interesting just picking on these points because it does feel like, at least within Hines, over the decades, as our business has evolved, we are now looking holistically up and down the stack, and we have credit, we do development, and we're able to think agnostically about where the best return is, and be able to kind of give investors that total solution, which I think is really interesting. So that's a convergence for us just internally. But also, as I think about the geographies and the where, it also feels like a lot of convergence in terms of even how governments are now getting more active in thinking about different industries they want to make sure are coming home and to their countries, their relative countries. And once that decision is made and once some investment is made, people often forget all the things that have to happen around that. It isn't just a factory to build X; it's all the things that end up supporting that. And so that's going to be something to watch too, from at least my perspective on convergence.
For our teams to really focus on where the best risk-adjusted returns are in the capital cycle, we can have a mind towards the next development cycle, but the here and now is about delivering returns for our investors, and that's been really a fantastic source of new investment for us. You then brought up a point about I'll say flipping a switch. The amount of capital that's been announced, whether you're talking about governments or hyperscalers, it's a tremendous amount of investment. The process to actually putting a shovel in the ground, as you know, is one that's a year to 3 years ahead of putting a shovel in the ground. And that's community stakeholder engagement, that's power procurement, that's entitlements, that's design, that's financing. All of the efforts that take to actually get to the point of putting a shovel in the ground takes a tremendous amount of time.
Maybe shifting to the investor operator convergence, I guess I'm curious what you're seeing on that in terms of that being a real thing that investors need to be alive to. And then where's the opportunity in that as well?
We've been an operator for 70 years, and we have a robust scaled investment management business on top of our operating platform. We have always felt that was a really powerful combination, bringing capital relationships and strong, sophisticated fund allocation and fund management together with the on-the-ground resource. We've always felt like that was really powerful. I think the framing of we are in a higher for longer environment, you have to create returns in a different way. And having the teams on the ground to create the alpha to support the investments is extremely powerful. So this is what we've been doing for a long time. The industry's been moving this way as well. The mergers and acquisitions business has only ramped up over the last 24 months, and it's allocators trying to identify how to acquire operators, and it's operators trying to figure out how to overlay with investment management or a capital formation business. That's happening through M&A. What I would be concerned about is just cultural ramifications of cobbling these things together. One of the things I love about Hines is it's one team at Hines that is operator and investor coming together, and that is really powerful.
It does feel like, I guess, two things you said. It does feel like, one, it is this barbell effect happening, and the middle is going to get squeezed, and you either have to scale or go niche. And there's ramifications on both. There's a business for both, but there's just ramifications for both. But then for those that are scaled, how they got there matters. Culture matters, those things. And I do agree that it's been great to see us make quick pivots and be able to move very quickly, especially this last year was a record year for us from an acquisition volume perspective. And that I love that because the cycle timing was great. I think that's gonna be a great vintage for all those investors that came along for us on that historic year. But what's also going to be interesting to see is how, as the cycle matures, and things do get liquidity is going to come back. It'll feel different in 24 months even. Where we find insights and how we unlock value and how we be able to identify that stuff gets hard, especially in liquid, transparent markets. And any edge you can find is a valuable edge. And I feel like this is one where our local teams have an incredible edge to be able to see things almost before it happens in a way, because they're living and breathing these markets. And that for me is one of the powerful unlocks. And I'm sure in the coming quarters and years, I know we're doing a lot on unlocking our own data and insights and predictive analytics. Maybe one last theme of convergence for us. We've kind of talked about this physical convergence. At the beginning, we talked about kind of allocation convergence, talked about investor operator convergence. One last one just on my mind is thinking about public markets and private markets. And it does feel like the public markets obviously have had a great run, the last, call it 15 years even. But that when you look at the numbers, that has been a diminishing pool of public companies relative to a exponential growth in global wealth. And so, the supply of money to go to opportunities, the demand, it feels a bit imbalanced, tilted towards the public markets. And it's interesting to see. I know we've been active in the private wealth world for a long time, and here of late have really leaned in further, just because we see it as a great opportunity set to serve a new client base. But it does feel like there is going to be convergence in the public-private markets in terms of investors looking for holistic solutions on that. I'm curious, kind of as you see the way we interact with investors, how we're bringing those two worlds together, because there is a historic way of working, and there's kind of an emerging way of working that maybe is yet to be fully defined. How we're thinking about those kind of capital engagement, capital wrappers coming together.
Well, I can think of a lot of ways that those are coming together right now. One that I'll say is that really post-COVID, most investors said, we might be interested in you developing new product, but we want the buildings to be shovel ready, all risks mitigated, GMP in place, debt in place. We want all the risks out of it, and then we'll come in and take advantage of the value creation on the vertical. Most institutions now have moved there to say, we're interested, but please mitigate all the risk before we're going to commit to the project. So that leaves a whole part of the development process that we talked about, the 3 years of entitlements, of power procurement, of community engagement, all of the things, the design, all that needs to happen. Some of our private market clients are saying, we're interested in participating in development, and we're interested in coming into that quote unquote higher risk period of time. And so when you think about private capital that's interested in one return and risk outcome, and public or institutional capital that's interested in another aspect of risk and return, bringing those two together is pretty powerful, because both sides can get what they're seeking at different stages of the investment landscape.
Right, and that's going to unlock opportunities for everybody. So that is exciting.
David, that was great. Thank you so much for taking time to chat today. I've really enjoyed this conversation. And thank you all for listening to us and for joining us today. It's been an interesting dialogue. Convergence is happening all around us, whether it's the investor and the operator convergence, or infrastructure merging real assets alongside real estate, or even just the asset classes converting together or merging together. Convergence is around us. So thank you for joining. Look forward to the next dialogue.